Canada just did something no one saw coming. It halted vital oil and electricity shipments to the United States. Shocking headlines claim President Trump was left speechless by this sudden move. How did the world's closest trading partners reach this standoff? And what does it mean for electric vehicles, oil, and a possible new trade war? Leaders on both sides scrambled to adjust, as the ripple effects could reshape North American energy forever. A decades-long energy relationship hits a crisis for years. Canada has been the top foreign supplier of energy to the United States. The U.S. Energy Information Administration, EIA, reports that in 2022, Canada sent over 3.5 million barrels of crude oil per day south of the border, roughly half of all U.S. crude imports. On top of that, Canadian provinces like Quebec and Manitoba supply large amounts of electricity, mainly from hydropower, to certain U.S. states. This seamless flow across the longest undefended border in the world used to symbolize trust and economic friendship. But now, in a sudden twist, Canada's government has turned off the taps. Literally, officials in Ottawa say they can no longer ignore what they view as unfair U.S. trade practices, plus repeated threats to Canadian exports under the Trump-era tariffs that still linger. New data from Statistics Canada reveals a 15% drop in Canadian exports of steel and aluminum to the U.S. since 2018, after multiple rounds of U.S. tariffs. Some Canadian lawmakers decided enough was enough. Their bold solution? Cut off vital oil and power to get Washington's attention. The triggering event insiders point to a fiery speech given in January by high-level U.S. officials about renegotiating cross-border pipelines and trade. Rumor has it that the Trump team, though out of office, still influences certain factions that push for heavier tariffs on imported goods, including those from Canada. This alarmed energy producers in Alberta who rely on stable U.S. demand. Whispers in Ottawa suggest Canada tried quiet diplomacy but got nowhere. Then came an unexpected vote in Canada's House of Commons, leading to an emergency measure: turn off certain pipeline flows and reduce power exports. A bar chart released by Canada's National Energy Board shows a sharp 20% dip in daily crude shipments to the U.S. within the first week of the cutoff. Meanwhile, Quebec's utility, Hydro-Quebec, confirmed a partial suspension of electricity exports, mostly affecting New England states. For many Americans, the news came as a shock, especially those used to stable energy supplies from their northern neighbor. Trump's initial reaction reporters claim that when news of the cutoff reached Trump's inner circle, there was a scramble to figure out how serious Canada was. No one expected America's closest ally to bite back so harshly. Past U.S. tariffs have angered Canada many times, but never resulted in such an extreme retaliation. One insider told a major U.S. newspaper that Trump was stunned and furious, demanding an immediate plan to restore flows. Yet the White House's public stance remained calm, at least at first. A spokesperson insisted the U.S. has plenty of domestic oil and doesn't rely heavily on Canadian electricity. However, an independent think tank, the Peterson Institute for International Economics, warns that losing Canada's oil could force some U.S. refineries to pay higher prices. While the U.S. produces large amounts of its own oil, not all refining complexes can easily switch from the heavier crude grades that Canada supplies. That mismatch might lead to supply disruptions and higher fuel costs if the standoff lasts. The electric vehicle angle, it's not just about oil. Electric vehicles, EVs, come into play here too. Many automakers in Canada and the US have begun integrating North American supply chains for batteries and other EV components. Canada's lithium and nickel resources help produce crucial battery materials. If cross-border trade stalls, EV makers may struggle to source needed metals. A line graph from the Canadian Automotive Parts Manufacturers Association shows EV-related exports rising 30% from 2021 to 2022. Now, with this new standoff, that growth could stall or even reverse. Moreover, some U.S. states rely on Canadian hydropower to balance their grids, especially as they transition to greener electricity. If Canada cuts more power exports, U.S. utilities might burn more natural gas or coal to fill the gap. That could slow the shift to cleaner energy and indirectly affect EV adoption. After all, the promise of EVs rests partly on a greener power grid. If the grid leans back on fossil fuels, it undermines the environmental case for electric cars. U.S. energy hubs feel the pinch. Refineries in the Midwest are among the first to feel the shock. States like Illinois, Michigan, and Ohio typically handle large volumes of Canadian crude, piping it to local refining centers. These refineries produce gasoline, diesel, and other fuels that feed into America's heartland. A quick cut in supply can disrupt day-to-day operations, forcing them to buy oil from elsewhere, potentially at higher prices. Early reports show some refineries paying a premium of $2 to $4 more per barrel on short-term markets. Those costs often pass down to consumers, which may push up gas prices at Midwest pumps. In the Northeast, the partial loss of Quebec's electricity supply might force states like Vermont and New York to ramp up local generation. Hydropower deals from Quebec saved these states millions of dollars each year, says a 2022 study by the National Renewable Energy Laboratory. Now, utilities might turn to pricier or dirtier energy sources, leading to bigger electric bills for consumers. Already, a handful of Northeast power suppliers have warned about potential rate increases if the standoff drags on. Canada's rationale and risks. Why would Canada take such a dramatic step? It's a high-stakes gamble. Officials in Ottawa see it as the only way to pressure the U.S. into rolling back punitive tariffs on metals and agricultural goods. They also resent the repeated threats against Canadian pipeline projects, such as the now cancelled Keystone XL expansion. Some politicians argue that America has used Canada's dependence on the U.S. market as leverage for too long. Of course, this move carries huge risks for Canada too. The country's economy depends heavily on energy exports. Oil alone made up about 17% of Canada's total export revenues in 2022, per Statistics Canada. Cutting shipments means losing daily income, which can hurt both Alberta's oil sector and the federal treasury. If the standoff lasts, Canadian producers might lose major U.S. clients who switch to other suppliers, like Mexico or domestic shale drillers. The electricity sector also faces hits, as cross-border power trade brought stable profits. Could a trade war erupt? This step certainly looks like the beginning of a broader trade war. Some members of Congress already call for retaliation, perhaps through new tariffs on Canadian goods or reimposing older tariffs that had been dropped. One senator labeled Canada's move economic sabotage, urging the White House to consider all options, including revisiting NAFTA or the current USMCA. The USMCA, which replaced NAFTA, normally ensures free trade among the US, Canada, and Mexico. But if Canada is actively blocking energy flows, critics argue that violates the spirit of the agreement. Meanwhile, Canada claims it's just returning the favor after years of trade barriers from Washington. They insist they'll restore oil and power exports if the U.S. lifts tariffs on Canadian steel, aluminum, and agricultural goods. Neither side shows signs of blinking first, raising the chance of a new North American trade war that could hammer industries like automotive manufacturing, electronics, and food processing, any sector relying on cross-border parts or raw materials. A bar graph from the U.S. Chamber of Commerce reveals that $2 billion in goods cross the U.S.-Canada border daily. If more penalties pop up, that figure may nosedive. The EV battlefront amid this tension, electric vehicles form a side battlefront. Both Canada and the U.S. push to grow EV production. The Biden administration's Inflation Reduction Act offers incentives for EVs built in North America. In theory, Canada can benefit if local factories supply parts for U.S.-bound electric cars. But if the two nations are at odds, who invests in new EV plants across the border? Automakers might shelve expansion plans, not knowing if tariffs or resource blockages will hamper profitability. Then there's the matter of battery metals. Canada's Ontario province has large deposits of nickel, while Quebec invests in lithium projects. American EV makers rely on stable supply chains for these minerals. A cut-off or slowdown means they must look elsewhere, perhaps to Africa or Australia. That might reduce near-term supplies, upping battery costs and stalling EV rollouts in the US. The net effect: slower decarbonization and less synergy in North American clean tech industries. Potential economic shockwaves. In the short term, the biggest winner might be other oil suppliers. OPEC members or countries like Nigeria, Angola, or Brazil could see more sales if U.S. refineries scramble for replacements. The losers: North American consumers who could pay more at the pump or higher utility bills. Manufacturers who rely on cheap energy in the Midwest also feel the pinch. Over months, if Canada holds the line, it might force structural changes in how energy flows across the continent. Credit rating agencies warn that prolonged supply cuts might slash Canada's GDP growth if energy exports plunge. Meanwhile, the U.S. could face inflationary pressure, especially if the shortage of Canadian crude coincides with rising global oil prices. Economists note that in a worst-case scenario, this dispute could trim to 0.3% off U.S. GDP growth next year. That's not catastrophic, but combined with other global risks, like the China-U.S. trade tension, it adds friction to the recovery from pandemic-related shocks. Reactions from BRICS nations. It's not just Washington watching. The BRICS group, Brazil, Russia, India, China, and South Africa, observes how this rift might shift energy markets. If the U.S. loses reliable oil from Canada, some BRICS countries see an opening to boost their own energy exports or cut deals with Canada on technology or trade. China, for instance, invests in Canadian natural resources. India might also want more oil if Canada is open to diversifying away from the U.S. A new East-West dynamic could emerge if Canada decides to pivot. In the worst scenario for the U.S., Canada might deepen ties with these emerging powers, forging a new alliance that bypasses American markets. Already, a leaked Canadian policy paper mentions exploring deeper trade with Asia if U.S. tariffs persist. That doesn't mean a quick pivot, given Canada's proximity and historical ties to the U.S., but it's a reminder that the energy chessboard is global, and the U.S. can't assume it's Canada's only major partner. Where do we go from here? Diplomats from both sides scramble to find a way out. Some politicians want a quick fix. The U.S. could lift certain tariffs. Canada reopens the oil taps, but the trust factor is low. Others suggest a broader renegotiation under the USMCA framework. If that fails, a deepening standoff may lead each side to impose new penalties, dragging industries like automotive, agriculture, and mining into the crossfire. Investors hate uncertainty. If no resolution appears, big companies might shift supply chains, relocate factories, or even slow EV investments in North America. That runs counter to the shared goal of building a strong, integrated clean tech sector. Meanwhile, farmers in both countries watch anxiously. Canadian grain producers worry about losing U.S. markets if a tariff war escalates, while American farmers fear ongoing retaliation from Ottawa. Everyone has something to lose here. Possible paths forward. 1. Rapid deal. Under pressure from business groups, U.S. leaders agree to remove some tariffs. 1. Canada reverses the oil and power cuts. 1. Ties warm, though tensions remain. 2. Full-blown trade. War. Canada doubles down if the U.S. retaliates with more tariffs. 2. Cross-border commerce drops. Consumer prices rise, and both economies suffer. 3. Partial resolution, ongoing disputes. Some deals are made, but neither side fully trusts the other. 3. Oil flows resume halfway. Power exports remain limited. 3. Future flare-ups loom. 4. Long-term realignment. Canada invests in shipping oil overseas or forging new Asia links. 4. The U.S. invests heavily in domestic energy to fill the gap. 4. North American integration declines. Which outcome emerges depends on political will. If cooler heads prevail, an agreement might appear soon. But if pride or populism dominates, the clash could intensify. With Trump's influence still stirring debates in Washington and Canadian leaders under pressure from their own voters, compromise is no sure bet. A private meeting is rumored to take place next week between top advisors on both sides. Will it bring a quick truce or push them closer to a full-on trade war? Some sources say the Canadians have even bigger surprises in store, like blocking shipments of critical EV battery metals. If that's true, the stakes just got higher, and the entire North American energy picture could be turned upside down.